All right, hello everybody. This is Bo Eckstein, and today we're going to be talking about the SBA 504 with a SBA 504 lending specialist. We got Carrie Hofferber. Anyway, I'm really excited to have you here, as I've over the last couple of years started to dive more and more into SBA financing from 7As to 504s, and really my clients are SBAs are for owner users, owner occupants that are going to be occupying 51% or more of the property. So a lot of my clients are seeking SBA financing because it's the best high leverage financing out there, and the rates are historically low. Plus, the government's probably going to start stimulating these SBA programs even more as we're working our way out of COVID. So I think it's a great time to talk about the 504 and really get a good grasp of what the capabilities of this loan product is. And I'm excited to kind of dive in with some questions. But Carrie, if you don't mind, maybe in like a quick background of like you, and I saw on your LinkedIn profile that you were a previous CPA, and then can you talk us through how you got into lending, and then how now you are the 504 SBA specialist? Give us a little bit of your background.
Yeah, both correct. I've been in finance my whole career since college. I did pass the CPA exam back in the 80s. I mean, that was a long time ago. But I've been doing SBA for 14 years now. And with the 504, it's a hybrid of percent conventional first and a 40% SBA second. And sometimes that down payment will increase if it's, say, a special use property, like, say, a hotel or a car wash. Then if it's a startup, it would be 20% down. But normally, most loans are 10% down. So it's a 50% first, 40% second, and 10% down. And as you said, the rates are historically low right now. In fact, they were down to like 2.2% back in, I think, October. Now they're 2.7%, but still a great rate. Our rate at our bank is prime plus one, which is 4.25, which is still not a bad rate. And then one advantage we have over most lenders is that we offer a 31-year term where the first year's interest only, then it kicks into a 30-year fully amortized loan that's then resets every 6 years, prime plus one. So, and as far as CDCs go, our bank has relationships with CDCs all across the nation because we're a nationwide lender. And we prefer to work with the ones that we've done business with before. And the key to that is their speed. I mean, some CDCs are so slow, but the ones we work with are pretty fast.
As we're walking through this deal, this hypothetical deal, we have a construction project of, let's just say it's a self-storage property. And your bank's going to fund the senior loan and the 40% SBA piece.
Correct.
Whereas other SBA lenders might have to get that outsourced, that funding piece. You do it all internally, right? So
correct.
So if you look at this overall, if you were to just go get a conventional loan for a construction or some kind of bridge construction product, you're looking at like 65 or 70% loan to cost. Whereas SBA 504, you can get super high leverage up to 90%. Now with the SBA piece, which is the second, that's actually a fixed rate product, so it doesn't adjust. And is that amortized over 25 years or 20 years?
25 years.
So me as kind of the middleman, let's say, commercial mortgage advisor, mortgage broker, I could go and find people that are, paying a higher rate and basically offer them a streamlined program. Is the timing shorter to do these streamlines?
The SBA is backed up right now. I mean, where it used to take maybe 2 or 3 days to get an approval from SBA, now it's taking like 3 weeks.
Do you have to put together a full package, I guess is the point, or is it a little bit more of a condensed package?
Well, you always need an updated personal financial statement and tax returns and everything. So we would have to get a complete package.
Can you just walk them through what you want initially to kind of say, okay, yes, this looks like a deal we could do. Here's the laundry list of things we need.
Well, the best thing is an executive summary to kind of describe the deal. So, I mean, that's the first thing I ask for. And then if that looks good, then send a sort checklist out of tax returns, resume, personal financial 413. And then I do a write-up. It takes me about a day to do a write-up. And then I submit that to management, and normally within 1 day I'll get an answer back. Our underwriting turnaround time right now is pretty good. It's like 5 days, which is pretty good. And then we send a commitment letter out, and then once they sign that and pay the deposits for the third-party closing costs, it goes right into closing. So that's kind of the process.
Sure. Let's talk about SBA, kind of like the standard SBA fees on a 504. Can you talk about the guarantee fee and what other fees are associated with SBA financing?
As a bank, we have to pay like 0.5% of the interim loan to the CDC. That's going to be waived. And then the CDC charges like 1.5% for kind of like an underwriting fee. That will be waived also. But the CDC, their full fees are normally like 2.4% or something like that. So it's not bad. And those can be financed, by the way. Those can be wrapped into the loan, as well as our fees with the bank.
So typically on the 504 piece, there's about, just as far as lender fees, there's about 2.4% guarantee fee.
Well, they have like 4 different levels of fees, but that's a total 2.4%.
Okay, and then obviously they're going to get a term sheet, once it goes through the process with the fees spelled out for the senior loan and the second SBA.
Exactly.
So it's a little bit. The costs are a little bit higher than a conventional loan, but you're getting 15 or 20% higher leverage at better rates typically. So that's why it's going SBA right now. And it's like we talked before, rates right now are historically low for SBA in general. There's a lot of SBA banks out there, but obviously your group's a preferred SBA provider and one of the biggest out there doing 504s. And last question. So the CDC, their funding is actually, it's SBA money that comes to the CDC that actually buys it. I still am a little unclear on that part.
It does come from the SBA.
Okay.
Unlike a 7A. 7A is the bank's money that they probably sell in the secondary market, like most 7A lenders do. But the SBA does fund the CDCs.
So our CDCs, are they for profit or nonprofit?
A lot of CDCs have a .com website, so they're for profit.
How do you explain a CDC in a kind of layman's terms?
A CDC is a government-backed entity that helps businesses employ more people.
All right, perfect. Well, thank you so much, Kerry, and I hope you enjoy this. We're going to bring you more and more value and educate everybody on the different loan products out there and how you can get high leverage and low cost of funds to grow your net worth and your business.
Are you in the market for a commercial loan? Did you find the perfect opportunity but need funding? Have a special situation? At Find the Bank, you will get quotes with competitive rates and terms from multiple lenders without any hassles. Have a multifamily property, construction project, owner-user property, industrial, mixed use, hotel? At Find the Bank, you can get nearly any kind of commercial financing. The process is simple. Once you send us some information about you and your property, we send back a quote sheet. Then we quickly connect you with an advisor. You won't spend hours calling multiple banks trying to find the right person to talk to. We'll connect you fast to the right person, hassle-free, better terms than you could get on your own. Go to findthebank.com and complete the form. An advisor will be connected with you within minutes to discuss your specific financing needs.
Today we are going to talk about your personal financial statement in capacity to why you're going to need it for lending purposes. So we're going to start with Form 413, which is an SBA personal financial statement. So you're going to hear Form 413. If you're applying for SBA financing, this is always kind of like the initial critical part is putting your assets and liabilities down on paper. And this is SBA's specific form. But whenever you're applying for any type of commercial financing, we always ask for a PFS, a personal financial statement. This is a critical piece is the sponsors or the borrowers, how do they look on paper, right? This is going to be a big indication of, are you going to be able to qualify for the financing on top of the business or the property, right? So you have to have, on business financing, you have to have creditworthiness and assets over liabilities. And your property or your business has to have cash flow. So if you're buying an existing business, they're going to ask for 3 years of historical tax returns. They're going to want 3 years of tax returns from the business so they can see the cash flow. So when you're buying an existing business, you got to make sure this business is cash flowing, because they're going to look for a debt service coverage ratio based on the cash flow. A lot of business owners don't want to pay taxes or pay less taxes, right? So they're going to have a lot of expenses. And so sometimes that's an issue when you're buying an existing business that's not cash flowing. Obviously, there's creative financing that could be a seller financed or a seller carryback second. You can put a little bit more money down, and then SBA loan amount could be reduced, right, to be able to cover itself from a debt service standpoint. But going back to Form 413, this is kind of, if you're going to be buying a franchise or a business, or if you're buying real estate, owner user, you're going to use Form 413, and that's basically your personal financial statement. When we're talking about commercial real estate, they always ask for your PFS for the sponsors, right? They want to see the financials. A lot of the Fannie, Freddie agency loans, they're looking to see that the sponsorships have a net worth greater to or equal to or greater than the loan amount being financed on agency debt. So SBA doesn't have those same guidelines, but they're looking for, the character, the creditworthiness, all these different kind of underwriting guidelines, and analyzing basically the ability for you to repay this business loan. And so it's important, whether you're buying a business or buying commercial property, is to have a detailed personal financial statement stored so you can update that daily. Because if you're buying a lot of real estate or buying businesses, you want everything dialed in. You want to schedule, especially in the commercial realm, you want to get detailed schedule of real estate owned with all acquisition dates and everything spelled out on a line by line basis. And keeping these stored somewhere safe is great, because you're going to need them ongoing as you get more and more properties, as you purchase and refinance more properties. You're going to need to have these documents handy. So I just wanted to go over today the importance of having this prepared, so when you're ready to buy a business or buy a piece of property, you have these important documents ready, because that's kind of the starting point of the conversation. To get an underwriter interested is they want to see your PFS. They want to see the if it's a new franchise that you're buying, a new business, they're going to want to see, is it an approved is it approved franchise already with SBA? What's the package look like? What's your sources and uses for the funds? What are you going to be using the funds for? And there's breakdowns for that. Usually there's a good overview with the franchise that you're buying. There's an overview of past performances, and they give you a lot of these tools that you can plug and play with based on your space or wherever your location where you're going to be operating the business. But PFS, very important. As you go from being a single family real estate investor to a commercial real estate investor, having a detailed personal financial statement is key. And that's why I wanted to kind of bring this to you today. So you can simply Google SBA Form 413, and you can get a copy of it. And you can also there's many templates online if you're not applying for SBA, but you need a template for a personal financial statement. I'm happy to provide a template. If you want to email me, that's great. Anyways, short episode, just want to go into the PFS and the importance of it. Hope you enjoyed. Please like, subscribe, and I will see you on the next episode. We're going to talk about, when is a SBA 7A a better option than a 504? And I go back and forth on this question all the time. And it really depends, okay? It depends on a lot of factors. One is it just hard assets that you're financing? Because that's what 504 is really good at financing, is the hard assets. Typically, those are going to be deals that are usually greater than 800, 900,000, anywhere up to 20 million plus. And the 504 is good for financing real estate, construction, real estate assets, and then hard assets as well. Where the 7A is really good is everything else in between, including real estate. The 7A is good for business acquisition, because on a 7A, it can finance blue sky or intangible versus the 504 can't. So to answer your question, it really depends on the deal itself, and there's lots of factors. For example, right now, I'm working on a transaction where we're taking an office building and converting to a hotel. The challenging part on the 504 is that it's hard to get a CDC or a nonprofit. They're the nonprofit that essentially works with SBA on the funding of the second, or the B piece of the loan. I guess you'd call it a second. And those CDCs are, they're not really interested in hotels at the moment, and most banks aren't either for ground up construction. Where I find the 7A is a more liberal loan, and we're able to get cool things done. For example, the 7A can work with CPACE in the capital stack, whereas the 504 can't. The 7A can have a pari passu conventional loan, meaning there's for example, the office building that's being converted to a hotel, we're looking at doing a $7.5 million combined loan, which would be a $2.5 million loan with the conventional piece, and then a $5 million SBA 7A loan. So that's $7.5 million in proceeds, because that's what the sponsor needs to get this project, all the construction done. So typically in the past, you'd be limited to $5 million, but there are banks that will participate and do a pari passu conventional loan. And that's just not for hotels. That could be for any type of projects. Assisted living, I've structured some for assisted living, self-storage, pretty much anything, right? There's a lot of ways to do it, but it's taking a lot of time with PPP and everything. Their backlog for CDC, loans, you're looking at probably 6 to 7 weeks the time they get a full package submitted to get SBA approval on that piece. You can actually get 100% financing, meaning you get the SBA 504, and that 10% could be a partial seller carryback. It could be a rollover from your. So there's creative ways even to bring in your equity. So there's lots of ways of structuring this, and when you're negotiating businesses to acquire a business, that's where you got to be creative, because a lot of times when you're underwriting these deals, we have to look at the past 3 years of the seller's tax returns, right? And oftentimes they write off everything. So it becomes more challenging to underwrite these deals. So sometimes you have to get a bigger seller carryback. It just got to be a little bit more creative on the way you structure these. But at the end of the day, on a business acquisition, if they're losing money on their tax returns, it's gonna be very difficult to get SBA loan. But SBA 7A will also work on projection based. They're more aggressive, versus 504 really doesn't work that great on projection based deals. So 7A is a lot quicker. 7A is a lot more flexible, but long-term kind of real estate backed type transactions is usually good for a 504. A lot of the banks overlay, and certain banks have appetites for certain different transactions. So it was really good to align with this non-bank SBA lender, because sometimes you can get a CDC on board to get the underwriting done first and then go full circle. So it really depends, because each deal is different. Each bank, each lender has a different appetite, but there's a lot of creativity that can be done to get these deals to the finish line, which is great, right? And at the end of the day, SBA is here to help small businesses, grow and thrive. And so it's fun as I dive more into the SBA world, learning and figuring out things, just the amazing tool it is. Anyway, I'm your host, Bo Eckstein, and I appreciate you, and I'll see you on the next episode.
Are you in the market for a commercial loan? Did you find the perfect opportunity but need funding? Have a special situation? At Find the Bank, you will get quotes with competitive rates and terms from multiple lenders without any hassles. Have a multifamily property, construction project, owner-user property, industrial, mixed use, hotel? At Find the Bank, you can get nearly any kind of commercial financing. The process is simple. Once you send us some information about you and your property, we send back a quote sheet. Then we quickly connect you with an advisor. You won't spend hours calling multiple banks trying to find the right person to talk to. We'll connect you fast to the right person, hassle-free. Better terms than you could get on your own. Go to findthebank.com and complete the form. An advisor will be connected with you within minutes to discuss your specific financing needs.
On today's show, we're going to discuss non-bank SBA financing. So, not every SBA lender is a bank. For an example, I have a project I'm working on right now, and it was very challenging trying to find a bank. I worked with a lender partner of mine, and they said, listen, if you can get CDC approval, we'll bank this loan. And on a construction deal, they're going to fund the first piece and the second piece, the interim construction loan. And then once there's certificate of occupancy, then the B piece or the second loan gets purchased essentially by the SBA or the nonprofit, the CDC, right? And then it goes into a fixed rate, 25-year AM. Right now it's sub 3% on a 25-year fixed rate. But the point is that there are these non-bank SBA lenders, not just for the 504 program, but also for the 7A program. And they can do a lot of really cool stuff. This is just a very short episode, but listen, if you have a project, it's an owner-user SBA type deal, just remember there's ways to do these deals, because I just got a letter of interest on a deal that was very challenging, and I'm going to get it done with a non-bank SBA partner of mine. Anyway, thank you so much for watching this show and for all the shows you've watched in the past. I will continue to shoot more and more episodes and also bring on more guests, so I'm not always talking. But anyway, thank you and have a terrific day. So if the bank is giving you trouble, remember, we've got a large list of preferred lenders we work with, and some of them are non-bank lenders and way more aggressive and have their little bit different underwriting guidelines. So anyway, this is just a very short episode, but listen, if you have a project, it's an owner-user SBA type deal, just remember there's ways to do these deals, because I just got a letter of interest on a deal that was very challenging, and I'm going to get it done with a non-bank SBA partner of mine. And on today's show, we're going to talk about the SBA 504 timeline for construction projects and approval. All right, let's start in on this one. So oftentimes I'll get a call from a business owner who's looking to expand their business, and they're looking to buy a building to move in and occupy at least 51% of the building, which is SBA guidelines, right? You have to occupy 51% of the building space. Let's kind of backtrack here on the process of sizing this up and seeing that one is that you're probably going to be eligible and get approved. Obviously, you got to have good financials. Your business has to have 2-3 years of previous experience. We always ask for 3 years previous tax returns, personal and business. 413 form, which is a personal financial statement. We also want to see a global debt schedule. Any other businesses, you're going to want to have to provide your tax returns. But really what that process is the initial application and due diligence checklist is fairly easy. It goes to the lender, and there's various lenders that fund SBA 504s, both bank and non-bank lenders. And it's just really about determining out of these banks and these lenders who has an appetite for this type of asset or property type or business in general. Some banks prefer certain asset classes, other banks are more generalized, but some really do specialize. Once the bank is identified, we put together the package, the summary of documents we need. Typically within a week to 2 weeks, we're looking at getting an LOI, a letter of interest from the lender. At that point, it's really about identifying a CDC, which is the third party kind of nonprofit that works hand in hand with the SBA. They need to be on board with it. They basically package up their piece of the loan, because there's the bank loan and then there's the CDC loan, which is the second. Until there's certificate of occupancy, that bank is funding the first and second piece. So 50% is the conventional piece, and then 30 to 40% is the CDC piece. But the CDC does not buy that piece until certificate of occupancy. There's a little bit of a process, but the bank needs to get confirmation that SBA CDC has approved the loan, right? Because they're not going to fund it until they know that they're going to be able to sell it to SBA or CDC rather. Anyhow, that's pretty much the process, but really what it comes down to is the basic sizing. Once you get your initial needs list over to the lender, they go through it. They might need a few more documents, back and forth a few times. They produce the LOI. At the same time, there's some conversations happening with these CDCs to make sure that they're on board with the project too, because without the CDC SBA approval, you're not really going to go anywhere. So it's a combination of bank and CDC being on the same page and working together. And that's kind of where my niche is as a commercial mortgage advisor, is being able to piece these deals together and make them work, because not every bank is the same. But the general timelines, I would say, from the time you submit a full initial package, it's about 2 weeks or less for a letter of interest, assuming you have all the documents they need. And then from there, once the CDC package is up, it's an additional 4 weeks, give or take, to get SBA approval. Here's the difference. The 504 only funds the hard assets of the business, including real estate and the equipment and things like that. Whereas the 7A is more geared for business acquisition and blue sky, intangible type stuff, but it can also fund real estate. So it's very versatile. And that's why sometimes you'll use the 7A over the 504 for commercial real estate. Today with a very special guest. Without further ado, welcome back to the show, Carrie. Carrie, thanks. Nice to have you again. And I look forward to talking in depth about the process of SBA financing and your 14 or 15 year career in the SBA world. Let's kind of dive in, and let's first start with, what's required for a 504 for the initial package. I mean, when a customer calls you or they call me, walk the customer or the viewer through what the approval process looks like, what they'll need to put together.
Okay, Bo. Once again, thank you for the opportunity to be on your podcast. As you mentioned, we got quite a few replies, and thank you very much for the opportunity. Just to touch upon what you said earlier, usually the decision to go with the 504 is sometimes loan size as well, because 7A is capped at 5 million, and then a 504 can go up to 10, 12, even beyond that, 10, 12 million. Even with the green program, you can go as high as 15 or 16 million. So sometimes it's the loan size that determines whether a borrower should go 7A or 504. But to answer your question, some lenders will have a questionnaire. I have a questionnaire I send as well, just some basic questions to ask about their credit, about it, if they've ever defaulted on a government loan, because that's important questions. Because later on, underwriting does a background check, but it's good to know that information up front. But that's kind of the core package we need. And then each situation is different. If I feel underwriting might benefit with some other additional information, I'll request that as well.
Got it. And so it's interesting. We had spoken on the phone yesterday, and literally right as we got off the phone, I had a potential customer client call for a 504. He's a restaurant owner, which is a difficult business to finance right now with SBA. But anyways, he's running a very successful restaurant, and he has they've been in business since 2006. 2.5, 3 years ago, they leased out another space with the plans of opening another restaurant. How will we look at the pro forma? How do the underwriters look at something like that from an underwriting standpoint for like a debt service coverage? Are they going to take into account the pro forma based on the new location because it's an expansion, or do they need the cash flow from the existing business to already support this second location?
Well, the scenario you just described is by far the best as far as a restaurant loan goes, because if a restaurant is a startup, it's going to be very difficult to finance it. But if it's a second location, it's a much stronger deal. In fact, I have one in my pipeline right now. It's not a second location, but they've been in business since 2005 and they're profitable. They want to buy their building. But in this scenario, the first question that I would ask, and I'm sure you asked this as well, is the second location going to have the same name, the same menu as the first location, or is it going to be like a different concept? If it's the same menu and the same name and it's a familiar brand, then the projections would be snapped because you can kind of mirror the first restaurant. But it gets a little bit more difficult if they're going to change the concept and have a different restaurant. But knowing that the owner is successful in their first location, underwriting would definitely take that into account and analyze the projections. And we would need what's called good assumptions on those projections as well, explaining how they expect to reach that certain income level and exemptions on their expenses like taxes, payroll, everything like that.
Let's kind of go back. So there's an initial conversation, either Carrie or myself having this with a potential borrower. There's a needs list, the Form 413, which is a personal financial statement. That's a specific form for SBA. A debt schedule. You want to show the existing debts of the business, and that's just a simple template. If you don't have a resume, we do have templates that can help you fill out your resume. They do want resumes on anybody that's going to be a signer for the loan. And what that means, a signer would be anybody that has 20% ownership or greater. So sometimes there's some smaller partners in the deal that own less than 20%. They don't necessarily need to go onto the loan. Sometimes underwriters will, if it looks like more of an investor deal, they will, from my understanding, like if they have 4 partners that each have 18%, and then or 2 partners that have 12%, and they don't like to see that kind of thing, right? Because they think that when they're looking at those type of deals, that they're trying to kind of work the system. So you got to be, when you're setting this up, you got to know the players and so forth, right? Like if you had a couple people that had less ownership, it looks more like an investment type deal versus the people that are on the loan application have the ownership, and maybe there's one other partner with less, and they're more of an equity or a silent partner per se.
And the SBA does allow that, but in each scenario is different. But and sometimes it's a lender call. Sometimes if somebody is a big investor and they have some kind of control as far as decisions go with the business, then the lender will ask that person to be a guarantor. But if the majority holder who does not put a large investment in, he will definitely be a guarantor and who makes the management decisions. But every deal is case by case. But some people do try to manipulate the system and have somebody who would put 100% of the down payment in. And lenders always want to see skin in the game from the main operator, the person who has the day-to-day control over business decisions.
But you can potentially get your 10% or 15% as a gift from family.
Yes. And then that's also, I mean, some lenders will allow 100% of the down payment to be a gift. Our bank, our CFO likes to see skin in the game. Even normally the general rules half gift and then half from the borrower, and that's also true with seller carries too. If there's a seller carry situation, I like to see half and half. But a gift has more strength though, because it doesn't have to be paid back, and the donor signs an affidavit to that effect.
Got it. So let's just kind of dive into the 504. I mean, based on, I know it's lender discretion, but SBA guidelines, will they allow for a seller credit? I mean, let's take the bank out and just talk strict 504. Hypothetically, could somebody get a 10 or 15% seller carryback from the seller as their down payment or is that an overlay specific to the banks?
It's like you said, it's a bank decision, and it can be 100% seller carry, but there's risk involved. And another unique thing is that a seller carry is different for a 504 than it is for a 7A. On a 504, the 504 SBA guidelines allow the seller to be paid back from day one, interest only in most cases. On a 7A, that seller carry has to be on standby for the entire length of the loan, meaning the seller can't receive any payments at all. So the seller carry is a little bit more flexible on a 504. And some lenders will allow the entire down payment to be in the form of a seller carry.
Yeah, I mean, that's definitely more high risk, and that's why a lot of banks do not want to do that.
Correct.
Right, because anything that doesn't have any skin in the game, the borrower is more likely to walk away because
that is so true. Well, that is so true.
But SBA, remember, you are signing personal guarantees. Now let's kind of walk into when and why 7A versus 504. This is such a common question, and I've been getting a lot of calls, and it's like I listen to the story of what they're trying to do, and I'm thinking in my head, okay, is it too small really for a 504? It's a $400,000 or $500,000 deal. There's not many banks that are going to do small 504s like that. It's just that, usually makes sense to do 7A. But really, when it comes down to it, I think there's some reasons why, like, for example, on a 7A, they're always going to look for additional collateral. So they're always going to look to put a lien on your primary residence or some of your rental properties that you do own. And that's like standard, right, Carrie? I mean, that's protocol. So that's a reason why a 504 would be superior, because you probably want to have flexibility of being able to use the equity in your primary house to do other things with. And so you could be limited if you have a second lien on the property, right? Exactly. So that's something you need to be aware of, why you might not want to use a 7A. Why you might want to use a 7A is because you can finance not only the real estate, but the intangibles, the business, right? So let's just say they're buying the building for $1 million and then they're buying the business for $250,000. You could only, on a 504, you can only finance the $1 million, right? Because that's the only thing financeable, that and the mortgage costs and so forth. But with the 7A, you can finance the intangibles in the business, so you could be doing potentially 90% of total project costs. So that's sometimes why you might want to do a 7A. But if you look at it from a cost perspective, not many lenders that I see out there are doing anything fixed rate with SBA. There's a few. Carrie's got a 7A product that will potentially do a fixed rate for 5 years or so. But the majority of SBA lenders I see, they're Wall Street Journal prime rate plus the margin, right? And it's a floating rate that changes monthly. And that is somewhere, I don't know, 5.75, 6%, 6.25%, right? Depending on the margin. For a lot of banks that I'm seeing pricing on business acquisition stuff. I think the pricing does get a little bit better if it's real estate backed. Is that kind of accurate, Carrie, what you see in the market?
Is.
Okay.
It is. And we're one of the few banks that, like you said, Bill, that offers a 5-year fixed, and it repeats every 5 years fixed, depending what the prime is. So technically it's a fixed rate the whole 25-year term, but it resets every 5 years.
Have you ever done a 504 with a companion 7A or?
Yes.
Okay.
So. Pretty much, because with 504s, working capital is not an eligible loan proceed outlay. So we'll do a small 7A for working capital or for inventory, whatever. It's called a piggyback loan.
Yeah. We call it piggyback, or some people call it companion. So
Yeah.
that's really cool, guys. Like, this is something a lot of people don't know about. That you can do a 504 with a piggyback or a companion 7A to get the proceeds you need. So on some deals that make sense, we can structure like that, which what that means to you, that means higher loan proceeds. So you could essentially, on 7A 504, you could essentially have you could have 3 or 4 different SBA's open. Like if you are owner operator of 2 different type of businesses, like I had a self-storage business that I ran in town, and I also then I wanted to go buy another business that I was going to operate. If it's 2 different businesses, guidelines, are they still okay with that? If you had experience in those kind of realms and you qualified other than that, and the debt coverage was good?
Yes.
You could have multiple SBA. I could have a $500,000. Like if I bought a business, for example, and I did a business acquisition with a 7A, and then I wanted to go buy a building for another business I had, and I was going to occupy that space, I could have collectively $5 million. But strategically, knowing that I could do the green, maybe I do the LAD if I'm going to constantly, if I'm building self-storage and I'm going to, build 5 locations. If you're strategic about it and you can put in some green elements to that, you might want to look at doing the green program, because that's going to help you.
Absolutely. And with the green loan program, you could have, it used to be unlimited, but now they've because a lot of hotel deals were just were infinite, but now they've reduced it to 3 green projects up to 5.5 million each. But collectively, that's over $40 million in purchasing power that you have with those 3 green loans.
And there's really specialty lenders out there too. Like some lenders they really love healthcare type assets. And so that's what I've really set out to do, is figure out who's the best of the best for different type of assets, because it makes the underwriting process easier. Like if I know what Carrie likes, I can bring Carrie, you have a pretty good appetite. Carrie likes to look at deals and he's going to underwrite it quickly. He wants to do as many deals as he can. He's got to work and try to beat up the underwriter to get them to sign off on the deal, because every bank's got some sort of credit committee and underwriting process. But Carrie's kind of like, he sees it, he's going to know, based on SBA guidelines, is this an eligible type of deal? And then he's going to want to do it if it's something that the bank can do. And he's going to size it up and put it through and get a quick underwriting decision and give you valuable feedback. So that's important, right? Because if you just go to one person or one bank, I have a lot of people that go to like their local bank, for example, and they don't get the best advice sometimes. Like, oh, well, 504 is not good for you. I'm going to do the 7A. And so they oftentimes steer their clients away from 504s. And from my understanding, banks make more money on 7As. So it could be a reason why they're easier, they make more money. So that's probably why a lot of banks always push 7A versus 504s. But Carrie's main focus, the point is Carrie's main focus is 504. All he wants to do is 504s. He can do 7As, but his focus and his business. So he's a guy you're going to get good information from. So I think circling back is that if you just go to one bank, you're only going to get what their little bank gives you, right? And you're either going to fit or not. So the point is you should get good advice from the start, and then it's going to help the process, whether I help you, Carrie helps you, or we just have a conversation and you get some information and maybe it's not a good fit for either of us. But that's really how I think that's really how I think you're going to find the best financing for your particular situation, because everybody has a different situation. So that's kind of my 2 cents on the lending world.
No, and Bo, I agree 100%. And I see it all the time where somebody would go to their local bank because that's where they have their accounts and everything. And a lot of local banks don't have a dedicated SBA department. And you are correct. If a bank sells a 7A loan on the secondary market, they're going to make the premiums are still pretty good right now. And some banks will make more money on a 7A. Our bank, we portfolio every 504 loan that we do. So we keep them on the books and, we earn the interest on them and everything. So, I mean, a lot of banks, there's a secondary market for 504 as well. Not as strong as 7A, but a bank like ours, we just keep them on the books.
So that means those other banks really, their incentive is churning. The more volume they do, the more money they make and so forth. So yeah, it's interesting just to learn the mechanics of how banks work, right? Because as a borrower, I borrow money all the time from lending institutions. So somebody who's listening, I hope you're getting a lot of value out of this conversation, because there's a lot of nuggets here where, how you can make yourself look better as a borrower. steps to do, action steps. I mean, you might not be SBA ready right now. Maybe your tax returns, maybe you haven't shown, you've had a business for 3 years and your tax returns are not showing what they need to show. Any advice on somebody who might be, they have good credit, but their business, they're getting ready to try to expand, but their cash flow might not be there. I mean, they got to just basically hunker down and know that they either need to put a very good plan together of why now they're going to start seeing growth after 3 or 4 years. Do you get those kind of situations too, where now they've had kind of marginal returns? I mean, they're profitable, but now they're trying to do a bigger kind of expansion. I mean, how do you get those type of deals approved? What's the shot to get those approved?
Well, in that case or that scenario you just described, a borrower may want to seriously consider hiring a professional to write a business plan for them.
Oh, I think that's huge, right? Because I mean, when you really think about it, this is your business, and if you get a little dinky executive summary, it's understandable, but really, underwriters are looking at that, credit committees looking at that, like, versus this really detailed professional story with professional, pro forma built in and things like that. So is it worth you to spend a couple grand so you can actually maybe even get more proceeds, right? The more detailed this is, and you're really stressing how the growth's going to happen and where it's happening, and it's identified in this, I'm sure that's helped numerous people get a lot more in loan proceeds because they were super detailed and they told the story correctly. So I would
absolutely
agree 100% that's, like, I'm looking eventually to buy some cash flow businesses that I can own and operate, right? So like knowing all this stuff is going to help me. And that's why we're doing this show is to hopefully help everybody out there that's looking to acquire a business or, move their chiropractic business into their own space and own the building or whatever, do some kind of rent replacement to create more wealth for their business. And not to mention, when you own the property, you also can take advantage of not only the appreciation, the mortgage pay down, and then also the depreciation of the property. So that's also a huge incentive for owning the property. And now with rates at historic lows and with property values, over the next 10 or 20 years, they're probably going to be worth more than they are today. We might have some slower times in between, but historically real estate always appreciates over the years. So it's always a good time. And I think it'll be interesting. I do think that SBA will maintain some kind of be aggressive over the next few years to keep the economy stimulated, because if there's any kind of recession or any kind of downturn in the economy, that's the one driver is the SBA can drive the economy by supporting local small businesses. And that's really they're what they're here for, is to help small businesses. And that's small businesses are defined as less than 500 employees, I believe. And
it depends on the industry.
Yeah. So there's certain guidelines for each industry, certain revenue guidelines, and certain net worth requirements. Like if you're a super whale and your true net worth is over $15 million or so, it's hard. But most people, when they send a financial statement and it says they're worth $30 million, the way SBA really looks at net worth is totally different. So sometimes people are like, well, am I going to have a problem, qualifying because my net worth is $32 million? And really, how do they take out the real estate from the financials? Do you know how they look at the actual net worth?
It's called tangible net worth, and I think that of course they'll take out any goodwill in their businesses, and of course depreciation. So it's called tangible net worth.
Yeah. So a lot of people that are $30-40 million net worth, at least they think, could qualify. So really, you could be pretty substantial and still get SBA financing.
And usually, in most cases, when you see somebody with a net worth like that, they've given a lot of value to their existing businesses as far as equity in their business. That usually makes up a majority of that net worth.
Well, that's usually how it is, right? Everybody thinks their house. When I used to sell real estate, everybody thinks their house is worth more than the neighbors, right? It's just the same thing. Everybody thinks their business is worth more than what it is. It's just it's funny because you'd go and say, okay, the next door neighbor is an identical model match to yours, and it's sold for $1 million. Why do you think your house is worth 1.2 million? It just, people just think their business or their assets are worth more because it's theirs.
And what's ironic, it's better to be conservative than it is to inflate the value of your equity in a business or whatever. So that's from an underwriting point of view. It's better to be more conservative.
All right. Well, great. I think we touched on a lot today. We'll definitely have you back for some encore sessions. I'd like to keep these. We almost went an hour. Goes quick. Any golden nuggets you want to leave us with going forward here?
Well, regarding 504s, they're supposed to be we've got some pretty good refinance benefits right now that weren't in place before. And there's some discussion in Congress whether to make these permanent. So and it's still being discussed. So we hope that happens, before the end of the year, where these temporary 504 refinance incentives will be permanent. I mean, to give you an example, normally to refinance a 504, to use a 504 loan to refinance debt, it has to be seasoned for 2 years. Right now, that's down to 6 months. So there's benefits like that would really help the program.
So can you refinance a conventional loan into an SBA?
Yes.
And you could wrap in, like, if you had some assets too, like if you had a couple loans on some hard assets, you could essentially wrap those all into a 504 refinance potentially?
Whatever is included in that 504 refinance has to be, whatever the original use of those funds were, it has to be 504 eligible. So if they want to refinance, like say the money they paid out of the business for their kids' college education, that wouldn't qualify, or they took a trip or something, it has to be business related.
So as long as it was business related.
Yeah.
But and you can also do a 504 into another 504 refi?
For expansion, currently for expansion. You can also refi a 7A into a 504 if it's for expansion.
Interesting.
Yeah.
See, there's all these nuggets out there, guys, and I hope you got a lot of value out of this episode. And Carrie, thank you again for coming on for the second time. And I think this one was even better than the first one. And love to keep doing this, every other month or so, and we'll do a new episode on highlight what's going on with guidelines. And actually, the next one we do, I'd love to do we can take a couple case studies and do a PowerPoint, and we don't need the addresses or anything, any details to the exact, property, location, business, but we can actually show how it was structured and maybe pick a couple different business types. And I think that would be really powerful to show, this is what the senior debt looked like. This is the junior debt. Here was the equity injection. This is how it was structured. Here was the general terms. And we can actually just show actually a couple case study deal structures. I think that would be very valuable for people to see how what it actually looks like.
And I do have a 504 PowerPoint presentation that is current up through the current incentives. I think I sent you a copy when you and I first started communicating, but it's an excellent PowerPoint. So maybe we can incorporate that the next time we do this.
That's very good. Well, thank you everybody for watching. Please like, subscribe. There's a calendar link below. Book a call with me if you want to talk about financing or business acquisition, anything real estate or business related. I'd love to talk to you about. And we'll put Carrie's information below as well. Feel free to reach out to Carrie. Probably send him an email. He actually picks up his phone too, and I don't think he minds giving out his cell phone number, but we'll give you his contact information below. And anyway, really appreciate you, Carrie. Thank you so much. And
both, thank you as well. Once again, appreciate the opportunity. And let's hope that that response time with SBA goes down quickly.
Yes, agreed.
Are you in the market for a commercial loan? Did you find the perfect opportunity but need funding? Have a special situation? At Find the Bank, you will get quotes with competitive rates and terms from multiple lenders without any hassles. Have a multifamily property, construction project, owner-user property, industrial, mixed use, hotel? At Find the Bank, you can get nearly any kind of commercial financing. The process is simple. Once you send us some information about you and your property, we send back a quote sheet. Then we quickly connect you with an advisor. You won't spend hours calling multiple banks trying to find the right person to talk to. We'll connect you fast to the right person, hassle-free. Better terms than you could get on your own. Go to findthebank.com and complete the form. An advisor will be connected with you within minutes to discuss your specific financing needs.
And on today's show, we're going to talk about the importance of an executive loan summary when you're applying for SBA 7A or a SBA 504 loan. And I was working on a deal recently, and I had submitted it to a banker friend of mine to take an initial look at what I call a pre-screen. And he said, is there an executive summary? And I think oftentimes as a commercial mortgage advisor, myself and my clients, we overlook the fact that the underwriter or the credit team that's looking at this deal in the future that you're looking for $1 million or $2 million of funding for, they don't really know you. They have a personal financial statement, your tax returns, and a debt schedule. They don't know about the particulars of the deal. They don't know this business you're buying. What's the strategy, right? So that's the importance of the executive summary. And it really clicked on me that I'm doing a disservice to my clients if I don't really reinforce the importance of taking a deep dive and really thinking and articulating an executive summary. Too many people out there, including myself, we rush to do things. But I'm telling you, take the time up front to really document the business, the executive summary. I have templates. I have example executive summaries. I have templates for projecting your revenues for the next 2 years. If you need help, I'm happy to help you. You can book a call below and we can discuss your opportunity. But kind of to reinforce the importance of writing a good executive summary. The better job you do, the easier it's going to be to get funded. Great, you have a 780 or 850 credit score. Great, you have a net worth of $3 million and you're borrowing $1 million. Great, you have a great W-2 job right now or a great business already. But if you want to get the approvals quicker, more efficiently, without jumping through hoops, without going back and forth, we really got to put these executive summaries together. And that is what I wanted to reinforce in this episode, is the importance of a really good executive summary. I am working with some consulting companies that actually help clients looking for financing write their business plans. They put together the pro formas, they do all of it, and it's relatively inexpensive and well worth it. So I'm putting all these resources together because, like I said, I'm getting inquiries every day now, and to efficiently get you more funding and get you the best rate and terms, it's all about doing the legwork up front with a very simple but very clear and defined executive summary. But I'm telling you, do the legwork up front and it's going to pay dividends. It's going to get you that funding that you need to grow and scale your business, to buy a new business, to expand your business, to go into a whole new field. So even if you're going into a whole different line of work, we still need to paint the picture that your skill sets are a good fit for this acquisition of this business. So that's the importance of the executive summary. Hope you enjoyed this episode. So thank you so much. Appreciate it. Please like, subscribe, and book a call if you want to. Thank you. Have a great day.